Have you heard of the ETF named GRFT?
Maybe, but I can't pick the ticker out of the air. So what does it do?
Aims to let Americans bet on Washington insider ties. So it is an ETF that's launched in the US that is based on the insider trading of politicians. And they titled Grift.
Welcome to Barenaked Money, the podcast where we strip down the complex world of finance to its bare essentials. With your hosts, Josh Sheluk and Colin White, portfolio managers with Barenaked Capital Management, Inc.
Welcome to the next edition of Barenaked Money. Josh and Colin coming at you. And we're going to try to educate people. This is the purpose of Barenaked Money. We're here to provide you information to allow you to make better decisions for yourself, to look after yourself a little bit better than you were yesterday. So we're hoping today that we're able to accomplish our goal, and I'm sure we will, because I ran out of room to record all of the things I wanted to talk about today. Because today, Josh, we're going to talk about bad investment products that have been launched recently that we have decided to highlight as part of what's wrong with the world. Is that a good enough description?
Well, you've been teasing this for a while. I think since we did a forward-looking 2025 podcast. So we're like 8 months into the year. You told me you could do one of these every quarter. So you better have an awesome list of products selected.
I ran out of ink to write things down. So as long as we have people's attention, I think we can talk about the next thing on the list. And I know you, Josh, you're not letting on, but you have a list somewhere.
I don't. I'm coming in totally blank slate for this one. So you're gonna amaze me with all of the long list that you have. It sounds like you have more than enough to cover a podcast worth of material. So I'm just gonna be here as your muse for a little while.
So you put the grandfather sweater on and you decided to sit back and not have lists. What's changed in your life, Josh?
So the grandfather sweater, you asked about it before the podcast. So I have this sweater sitting in the office for when it's cold out. Now today it's like 40 degrees with the humidity. So it's like, why are you wearing this? So I went to the doctor with Grant before I came to the office this morning. He had to get a vaccination, a chickenpox vaccination. So he got it, no problem, everything's good. But I gave him some Tylenol to help stem any fever. And Tylenol, it's liquid for his age. He's a year and a half. So he immediately spit it onto me. So I was like, okay, that's probably going to dry. I got to the office an hour later and it didn't dry. So that's why I'm here sitting in a sweater, because I don't want to have the marks, the stains from my child's medicine all over me for the whole day.
You're right. It's way easier to explain the sweater than it would be to explain the stain on your shirt. I get it. All right, fair enough. Decisions were made.
Well, people don't ask about the stain. They're just like, this guy's a slob. Like, what is he doing?
All right, Josh, listen, the first one I want to talk about, and I want to really lean into you on this one because you're the technical guy. You're the guy that really gets into the meat of these things. These 0-day products that seem to have proliferated out of nowhere. Like I don't remember in my career seeing such a flurry of this 0-day stuff getting proffered onto the market. Was I asleep and missed this in the past, or is this a recurrence of something, or is this, and maybe for the audience's sake, I'm just calling it 0-day. Maybe you can explain it more technically as to what it is.
Yeah, so with a different type of security, a specific type of security or specific type of investment called an option, you actually have an expiration on the option. So at a specific date and time, that option no longer trades. It no longer exists. It basically is kind of wrapped up, and you can either get a payout on the option or you can sell it, or there's a variety of different things that can happen. But basically, this is a way for you to invest in let's call it a stock-like instrument just for simplicity, and it expires at a specific point in time. So when you say 0-day, what people are doing or what investors are doing is buying an option that expires at the end of the day. So you're essentially making a play on what's going to happen on that specific day with that specific stock or that specific market.
Well, maybe I can go back to the movies because just to help our listeners understand that, because this is the example that kind of sticks with me from way back in the day about somebody buying an option on orange juice. and they've got an option on 500 pounds or 500 tons of orange juice, and they forget they have the contract, and then the truck shows up outside their house to deliver the orange juice because they were contracted to the orange juice. And they're going, "What's this?" "Well, this is the orange juice future that you want." It's like, yeah, it's a future. No, no. Well, the future's now. You let the contract get all the way to the end, so this is what you have to deal with. So that's kind of in a very simplistic, very civilized way to explain it. I've also seen it in the movies where they've done it with pork belly futures, so a bunch of pigs show up. So if you're trading on a commodity, is one way that this kind of happens. But Josh, the market has a real basic way of dealing with this. They basically pair up contracts at the end and kind of, rinse things out. Like why is the trading of these, or the launching of an ETF that trades in 0 day, all of a sudden become a thing? Do you have any sense as to how we got here?
Yeah, so options are all executed, at least all options on stocks are executed against a market maker. So it's not like a stock where you're buying and selling against another investor. You're buying and selling against some type of institution, and they will take both sides of that trade. So they'll sell a call option to you and buy a call option from somebody else, or vice versa, or same with puts, right? So the market maker is essentially taking both sides of the trade, and they're hedging their exposure on both sides of the trade. So the market maker themselves, all they want is as much volume in trading and activity as possible, because that helps them make sure that they're hedging their position, and that helps them generate income. They're charging a spread on what they're buying and selling. So it's advantageous for them to be as much activity, as many market participants as possible. 0 day options have always existed. Like, as you get closer, every option expires. So as you get closer to expiry, you've always had the option to purchase 0 day options. But I don't know why it's become a thing over the recent history. I think my sense is that it's tied to this whole retail trading, Reddit trading type of mentality, very short-termism, and people trying to make a very, very quick buck, I suppose. And that's type of the narrative around it, I guess, has driven some of the more activity in that space as well.
So there's fees and then there are hills, I guess would be another way of saying it. Like, they're able to generate a fee on the ETF that they have out there, right?
Well, yeah. So that I was just trying to explain why 0 day options have become a thing, but now we're starting, because as we know, as we're really going to talk about here, anything that draws interest from investors is going to be productified. Is that a good word? Productized.
Productified is, I'm going to use that, Josh, like that.
Yeah.
We've just witnessed the birth of a word.
There you go. So the investment industry will turn anything that has appeal to it, rightly or wrongly, into a product they can sell and they can make money off of. So that's what we've seen, as I knock my microphone over, out of outrage. Well, that's what we've seen now, is that there's actually starting to be products launched on this idea of 0 day options. And I don't know who they're appealing to. I expect they're appealing to the people that are trading these 0 day options, what I think are mostly retail investors, do-it-yourselfers. But yeah, and as soon as you turn something into a product, you charge a management fee on the product, and away you go. Now you're earning income to do something that may or may not be smart.
Well, it's like when the product based on the VIX came out, they were going like, you're not supposed to be able to trade with the VIX. The VIX is a calculation. Like, how do we have a product on this? But actually, you said something really, really important, I think, in your explanation. The market maker takes both sides of this, and they just want to see activity. So the big guys are doing their thing with it, and they're making money off it. Now, they've just introduced another layer of profit because there's a group of people now willing to buy it. And that goes back to the industry and its desire to, whatever somebody's going to buy, they're going to manufacture. I had Maria on the team check to see how many Canadian mutual funds are currently listed, and we've cracked 21,000 now. So there are over 21,000 mutual funds listed in Canada for your dining pleasure, which I guess is a pretty good indication that anything that somebody wants to buy is probably available somewhere. So the product that's come out, the 0 day product, is an exchange traded fund. And I believe it comes with the proviso that it's not designed as a buy and hold, it's designed as a trade. But my mind just starts to spin. Like, money flows into it. The market maker that day is looking for 0-day contracts that day. Like that, the arbitrage opportunities and the efficiency of trying to execute on that, I can't even begin to imagine.
Well, yeah, I don't know enough about that space. It's been a while since I've been talking directly to market makers on those types of things, but I guess towards the 0-day, the last day of the trading for the underlying instrument, there's probably a sort of a flurry of activity that happens around that because people are looking, or investors are looking to close out contracts, mostly close out contracts. Like so they've launched daily options, have become a thing and become more of a thing over the last several years. And mostly these dailies, I think, are on indexes, not on individual stocks. But I just don't know who's trying to make these investment decisions. Like, who is it that is buying and selling these things? Like, how do you really have a call or investment thesis over a 1-day period? I don't know. So it's a little bit unbeknownst to me as to exactly what's happening and why. But the bottom line is, what I can say with quite a bit of conviction is the market maker, at the end of the day, the person that's taking both sides of the trade, all they want is activity, and they want as much activity as possible because that's helping them generate more profit for their bottom line. So if people want the product, if people want 0-day options or daily options, they're going to provide it to them.
All right. So for our audience, I want everybody to note that Josh said, I don't know. And if Josh doesn't know, everybody else should just give up trying. The difficulty and the complexity of what this product may or may not be, I think, and Josh, you probably agree with me on this, is probably beyond the ability of a retail investor to have a really firm grasp of what's going on and know how to deploy something like that in a portfolio. Is that a fair?
Yeah, like I do want to highlight, I don't know. There's probably some investors or organization or institution out there somewhere that daily options make sense for, or 0-day options make sense for. I don't know who that is, and I know it's probably not the majority of people listening to this podcast. So can you maybe understand what's going on? Yeah, sure. I don't think 0-day options are extremely complex, but I think the bigger thing for me is, why are you trying to make an investment decision based off something that needs to happen in the next 6 hours? Like that's what it is. The market opens at 9, it closes at 9:30, it closes at 4. You need something to happen in 6 hours for your investment thesis to play out. Like, how does that make any sense?
Yeah. Well, you said it, like that's an institutional thing, and there can be lots of reasons. And again, we could debate the institutional use of these kinds of products and strategies for sure. But to turn it into an ETF and make it available to a retail investor, that's where I think it goes into the ditch. Anyway, I was fascinated by that one because I've never seen that turned into. And living in a time when we've seen the VIX turned into a product, which is just a measure of volatility, I thought maybe I'd seen everything turned into a product. But anyway, I've lived long enough to stop saying that. I'm sure I'm going to see it. So Josh, I had a few things sent to me in addition to the ones I found. So this one, I thought that this was coming from the Onion when I first got it, because I thought there's no way this is real. Have you heard of the ETF named GRFT?
Maybe, but I can't pick the ticker out of the air. So what does it do?
Aims to let Americans bet on Washington insider ties. So it is an ETF that's launched in the US that is based on the insider trading of politicians. And they titled Grift. Like, I thought that had to be the Onion. But I'm looking at a Bloomberg report right now describing this product. Matthew Tuttle is launching an exchange-traded fund, Grift, that aims to profit from political influence in corporate America by holding a portfolio of companies with ties to the politically connected. That sounds like a good product, don't you think, Josh?
I mean, if you have an investment thesis, or if you believe that there's some shady stuff going on in politics and there's a bit of the greasing of the wheels, then maybe it is a really good investment idea. I don't know.
So, I mean, it would seem to run afoul of a couple, I don't know, fairly basic tenets of investing about fundamental analysis or profitability or being able to get something at a discount, and kind of going all in on, there's insider trading going on and I want to be on the inside. But does this not strike you as maybe grift squared? Like you're launching a product that's based on, as they've described it, a grift. So it's a product on a product kind of thing. I'm just stunned. I'm stunned at the ticker that they've given it. I'm stunned at the concept.
Yeah, they're really leaning into representing what it is, right? They're not shying away. They're not trying to institutionalize, or what's the word I'm looking for? Like, turn it into anything that there's actually research or credibility to. They're just calling it exactly what it is.
And they're loosely defining it. It's not like it's a really tight definition. It's like, politically connected people. Like, well, for the love of God, you can put anything in there then and call it, somehow politically connected. So
Yeah.
I
Is there
remember,
any explanation as to how the portfolio is actually built?
I'm glad you asked. The fund strategy involves targeting holdings disclosed by members of Congress, companies with ties to a sitting U.S. president, and short-term trades linked to presidential praise or social media commentary. See,
Okay. So we're scouring X to see who's posted about what companies.
it is.
Interesting.
There was, I listened to, I think it was PBS in the U.S. There's one of the journalists down there. They had this idea back on Trump's last presidency, because Trump likes to tweet out about companies at different times. So they set up a bot, which basically would monitor his Twitter account. And every time something was mentioned, in good news or bad news, it was either bought or sold based on what was tweeted. And they
Yeah.
went back to it like 6 months later, and it had not placed a trade because there hadn't been one tweet go out while the market was open. And it, oh, okay. All right. Well, we weren't expecting that. So
Yeah.
again, we sit back and think that there's no rhyme or reason to some of this, but maybe there's a bit of a rhyme and or a reason to some. But that one made my list just because of the ticker they chose. Seems a little bit too on point.
Yeah. Yeah. Well, it's again, as we said, the people will make a product for anything. So some of the stuff that comes out of the US just astounds me in terms of like the ridiculousness of it. There's just no shame with some of the product providers, it seems.
And this one here is going to count on your institutional knowledge, Josh, of things that have gone before. Are you ready to dig back into your memory banks and pull out details that'll you're going to get the punchline on this one, because this is a name you should recognize. Remember
All right.
Kathy Wood?
Oh, yes.
Yeah. Well, she's back, because, she had to launch something else. So she has let's just see here, a buffer ETF designed to limit equity losses. So ARK Investment Manager is launching 4 exchange-traded funds, ETFs, designed to limit equity losses with the goal of protecting investors against modest losses while still offering upside.
That's important for her because she's had such a disastrous track record with capital losses over the last 5 years.
Well, I think that you want somebody who's really good at losing equity money to launch a product like this, because she's probably very experienced at it, right? And Josh, I'm sorry, I'm putting you on the spot. Can you give any context to what we're alluding to here with what her losses were that she had in the marketplace?
Well, let me look it up, because the number off the top of my head seems to be somewhere in the 80% range. So just as I look it up here, the most questions I got about this ETF, and probably any like random ETF, was during the 2021 hype around this product. And there's a couple related products, but it was right around that time. And for her main ARC product. And I remember my sister's a personal trainer. So she texted me, she said, "Hey, one of my clients wanted to know your opinion on this ARC ETF." And I was like, what are these people talking to my sister about? And at the time I was like, look, this thing is very, very concentrated and tech focused, and you just got to be really careful with it. And sure enough, like, it's been a disastrous investment for anybody over that the stretch of time that we're talking about. So it peaked, I'm just looking up, peaked in 2021, roughly February, at roughly $156. It's currently trading at about 76. So 4.5 or so years later, it's lost about half of its value. And from peak to trough, it went from 156 to about 31. So pretty much bang on what I said. It was about an 80% drawdown. So that's who we're now trusting to put a buffer in place to avoid drawdowns. I guess she really needs it, but this has been a disastrous investment for so many people that chased it at the exact wrong time.
But Josh, you're framing this all wrong. You don't know how to frame things at all, because, the move comes as ARC's actively managed ETFs has seen over $3 billion in net outflows over the last 12 months, despite posting double-digit gains over the same period.
Yeah. Yeah.
People just don't get it, Josh. Like you're just being a negative Nelly. Like come on now.
Yeah. Double-digit gains over the last 12 months, but 50% losses over the last 4 years. So I'm actually happy that those outflows have still continued and people haven't lost sight of the bigger picture, that this has been disastrous for a lot of people. And it's more than just bad performance. It's like, if you actually listen to the ideas or beliefs of the team here behind it, they're just outlandish. They're outlandish claims, and that can get you so far for so long. But when you're not actually hitting some of those claims and maybe getting extremely lucky with some of those claims, then it can be disastrous. And that's what we've seen. And it's really sad, because I think people have lost billions of dollars investing in these products.
Oh no, look, absolutely. And they also, the product that she's launching there limit losses to about 50% of any drop in the share price of the innovative ETF, while allowing full participation in gains above a set hurdle rate around 5%. That description, I mean, that kind of product has been out there for a while. And I guess, again, this is where you're the expert. That's more of a note kind of structure that we would more commonly see that are done either in principal at risk or principal protected notes. And those have been around for quite a long time. And there's an absolute trade-off and a fairly significant cost to that kind of product. Would that be fair?
Yeah. I think this is going to be thematic through everything that we talk about today, or at least a lot of the products, is there's a cost to every protection that you put onto something. So you're exactly right. These products have been around for a while, and generally, as we were talking about options before, generally they're overlaying some type of option strategy on the underlying stocks that they're buying. And so that's how you can limit losses. But like, you're limiting losses to 50%. Like, only somebody that can lose 80% of your capital in a short period of time needs to limit losses to 50%. That's crazy.
And call it a win.
Yeah, because even the worst periods of time in the last 100 years, I mean, aside from the 1930s, we look at 2008, and even at that time, you had about 50% losses for the stock market as a whole.
Josh, I'm sorry, I got to correct just in the interest of being fair and accurate here. To 50% of any drop. So it's not an absolute limit of 50%. Okay. It's 50% of any drop. So just
any drop. Okay, gotcha.
So just in the interest of being fair, I mean, we're still going to beat up on people, but we don't want to beat up on them unnecessarily.
Unfairly, yes.
Yeah, exactly.
We only want to beat up on them fairly.
Yeah, exactly. Right. Exactly.
Factually, yes.
So this one is Trump media furthers push into crypto with third ETF filing. So apparently they put a third okay, so Trump Media and Technology has filed for an exchange-traded fund called Crypto Blue Chip. Well, all digital
blue
assets,
chip crypto,
including Bitcoin, Ether, Solana, and others. And XRP, it's going to hold XRP as well. 3/4 compromised to Bitcoin and would join a crowded field of crypto-minded. Yeah, so it's, Josh, I mean, come on now. Blue chip. I've been trained my whole career that investing blue chip is low risk, and all the really uber wealthy people. Yeah. Crypto blue chip.
Yeah. Well, it is all the blue chips of crypto, all that stuff that's been around for like between 18 and 24 months, right? Mm-hmm. So, the long standing players in the Bitcoin space, or the crypto space rather. But my question for you, Colin, is how much of the Grift portfolio do you think is going to be made up of this new ETF? Because this seems to be very aligned with some of that grifting that we talked about before.
Yeah, no, there could be overlap here. There's a real danger of over-concentration here. Like, so, we don't want, to be layering strategy on top of strategy, which is all the same strategy. Then you end up with strategy squared. And And is that really what you want? Desjardins has just launched a Quebec Equity ETF. So you can buy an ETF that holds nothing but Quebec-based businesses. How many Quebec-based businesses are there, Josh?
So actually, you'd be surprised at how many quality Quebec-based businesses there are on the TSX. It's not a ton. It's not lots, but there are a lot of good quality businesses that have originated from Quebec in Canada. You look at like Couche-Tard, for example, which is probably the most prominent one. They're not just Quebec-based, but and I don't know if there's anything to this, but there do seem to be some high-quality Canadian businesses that have high returns on equity and good, solid businesses that have originated from Quebec. Now, would I ever base a product or an investment philosophy off of it? No, but there's probably more than you think at first glance, and you've probably done the research, so you probably know that.
Oh, no, this is absolutely, and this is not disparaging to the businesses based in Quebec, because Couche-Tard is a global power based out of Quebec. So they do have businesses there, but I am more appalled or attacking the idea of trying to accomplish a non-financial goal with a financial asset, because that's what this is set out to do. So basically for people that are trying to keep their money in province because they think that that's, the thing to do, you're going to end up with a non-optimal portfolio. You're not going to be able to balance a risk and return as well as you could in fishing in a bigger pool. And moreover, when these things really go sideways and you start raising more capital than can actually be absorbed by the market, you end up seeing, the degradation of the quality of the companies. So whenever you see something targeted that's raising capital in a specific sector, it can get to a point where, there's too much money flowing in, and then it actually degrades the quality of the businesses that are there, because you no longer have to be competitive. You just have to have a label, whether that's green or whether that's marijuana or whatever it is. And then you end up, that money absolutely gets burnt for heat. So that's always kind of trying to accomplish non-financial goals with a financial asset. Whenever that's the theme, that always, catches my eye.
Yeah, I pulled up the list of holdings here actually because I was kind of interested in what's there, and it is a list of good businesses. But the other thing with this is like, okay, well, we're investing in Quebec, or we're investing in Ontario, or whatever it is, we're investing in the GTA. It's like, okay, but all of these companies are mostly, at least the top holdings, they're global businesses. They probably have a lot more of their revenue source outside of Quebec than they do inside of Quebec. So like, how much are you actually investing in Quebec and we make this mistake so often. I think it's not just this product. It's like worldwide we do this. We talk about, oh, like this is a US business, or this is a Japanese business, or this is a Canadian business. Well, they're all global businesses the way that we operate these days. Like if you look at the S&P 500, I think something like 40% of the revenues of those companies in the S&P 500 are derived from outside of the US. So it's just, things are so sort of blurred now in terms of like, yeah, I can buy a business that's based here in Ontario or Quebec or whatever, but it could source so much of its revenue and sales globally that how much is it actually representative of that economy?
Well, yeah, no, if that company's got 80% of its workforce outside of the geographic area that you're talking about, or there can be all kinds of the economic benefits could be flowing outside. So even if you're trying to accomplish a goal, it may not be able to be accomplished. You're not doing what you think you're doing, and you're harming yourself again, because every time you limit your investment pool, you're changing the math. And that's it. All right, so here we go. You ready for this one? I didn't think this would come back. I thought that there was a product that was launched like this in gold a little while ago, but this has come back. So get the Beta Pro 3 times S&P 500 daily leveraged bull alternative ETF, and the Beta Pro minus 3 times S&P 500 daily long leveraged bear alternative.
Yeah. So these are probably some of the most damaging products you can find. Again, you're making a call on literally a 1-day time horizon. That's what it is. And you can look at the offering documents for these products, and they say these are not designed for buy and hold. They're designed for very short-term price movements. So, we spend more time thinking about markets than I'd say like 99.9% of the population. combined between the two of us. And I don't think either of us believe that we have any ability to predict what's going to happen tomorrow or next week or next month for that matter. So I don't know why people believe that they can.
Well, see, and here's the problem. So they launched this product, and yeah, there's a disclaimer that goes with it, like this is for active traders. Like it's not a buy and hold. One of the reasons they have that disclaimer was, I don't know if you remember the Bear and Bull Gold ETFs that got launched, a number of years ago, double and triple Bear Gold. And both of them were lost like huge double digits over the same year. And class action lawsuits were launched going, how can the Bear and the Bull ETF both lose money over a year? And then they get into, okay, well, here's how the contracts work and the degradation of the contracts and the term of the contracts, because this is all options trading, right? So, you've got all kinds of things that are going to erode value over time. So, but again, it's giving the do-it-yourself investor the misconception that if they think things are going to go bad, that they can profit from it. If they think things are going to go good, they can profit 3 times as much. So you can do that just, so I would make sure that everybody knows you can do that on both the S&P 500 and the NASDAQ 100. Like, so you can even pick a more volatile index to 3 times it. So those are all available to you. And for the record, no, we're not calling this a good idea, right, Josh? Like, just to be clear, we're making fun of it. I'm not sure that's clear this time, but we're making fun of this.
Well, I did find in my search at one point a 5 times levered ETF based out of Cyprus. So that if you have to go overseas to Cyprus to source the product, it's probably not a good idea.
Well, that's interesting because I have never seen anything go higher than 3 times in North America. So probably somebody in
It's got to be regulated, right?
Has put a limit. It's like, this is the level of stupid that we're going to let out into the world.
Yeah.
Anything above that is going to be crazy. And
yeah.
So I'd like to meet that person that made that decision, because
that's right.
It seems still pretty. All right.
Do you have the levered single stock ETFs on your list?
It's the next one.
Am I stealing your thunder?
The next one.
Roll right into it.
Harvest Portfolios Group launched the Harvest Apple Enhanced High Income Share ETF, trading under the symbol APLE. That's not confusing, on the TSX. That reminds me of people that show up in Sydney, Nova Scotia, think landing in Sydney, Australia. Like, the name is going to cause people to purchase this thinking they're actually buying the stock. I guarantee that's going to happen.
Well, I'll tell you a funny story related to that. And it ties into all this stuff that we're talking about. But when I worked for iTrade a while back, this is like almost 15 years ago now, there's a story about a guy who bought Google options that were literally 0 day to expiry, right? So they were expiring that afternoon. And I guess the investor looked at them and said, holy shit, I can buy Google for 10 cents? It was like $1,000 just yesterday. I'm going to load up and buy these 10-cent Google shares. Sure enough, they were options, not the shares. And they expired worthless at the end of the day, as they tend to do. And the funniest part is he actually sued the discount brokerage. He said it wasn't transparent enough. It wasn't obvious enough that he was going to lose all his money on this. So he sued the organization, the financial institution. So I don't know what happened from the lawsuit, but that's 0 day options in a nutshell. And that's leveraged investing in a nutshell. And that's the stupidity of retail investors getting over their heads with products in a nutshell.
Well, again, it's based on the premise that if I can sell it, I'm going to build it. And, with no care or concern necessarily to how badly it's going to turn out. And, again, stuff like that, even the naming nomenclature and something, trying to make it look like a stock. I mean, come on. Like, I don't care who
somebody's
going to
mistakenly buy that, right? Somebody's going to mistakenly buy that, and they're going to realize they have a levered covered call position or whatever the hell it is. Enhanced high yield, right? That's what you said.
Yeah, enhanced high yield. That sounds way better. Who does not want to be enhanced and have high yield, Josh?
Yeah, I want to do that personally. I don't.
Absolutely.
As a human being, I want to be an enhanced high yield human being.
There's just so much to like in the naming of these things. Oh, this is going forever. All right, so here's the next one.
But hold on. Can we stay with that for a second? Because I guess the enhanced part is that it's levered, correct? And the high yield part is that they layer a covered call on it. Am I understanding it correctly?
Yeah, well, it is levered. It's right in the title. But yeah, it's a covered call is what's giving the yield, right? That's how all of these things choose their yield. And just to explain to our audience, like when you're buying ostensibly, would Apple still be considered a growth company? Is that still?
I don't know what and this is part of the problem with this is there's no actual definition of what a growth company is. I think it's probably losing a bit of its luster in that space now.
So well, for a second, I think we can talk about what the covered call strategy is like. Basically, if you've got a company that's paying out a dividend and you think it's going to be a stable company, you can increase your yield off of that by selling contracts and pocketing the premium on those contracts. But what you're giving away is if the stock goes up, then you're going to give away some of the growth in the stock. So basically, somebody's willing to bet against you and say, yeah, we think the stock's going up that much. And if you don't think it's going up, you sell the contract and then you profit by pocketing the premium. So in a world where people are starved for yield or think yield's the be all and end all, and I think it's what they need to focus on, that really makes the product more attractive. Is that a fair explanation of that aspect of things?
Very much so. And this was actually going to be my theme for I didn't come with a specific product, but I came with a specific idea that I think is the worst investment idea sort of collectively. And I shouldn't say worst. I shouldn't say worst, but it's so prevalent and so pervasive now. And I just don't think people understand what they're doing to themselves by buying covered call strategies, because I think they see the yield and the premium that is generated by these strategies, and they think that's awesome. And it can be at times. But as you said, what you're doing when you sell covered calls is you're capping your upside. And I don't know about you, Colin, but the only reason I own stocks is for their upside. And they tend to rip very quickly in very short periods of time to significant magnitudes. And sometimes they trade sideways for a while. And if you're capping that upside that you're getting, if you're capping all of that appreciation that you typically get over short periods of time, then I think you're doing yourself a disservice. And there's been academic research on this too. I think these products are positioned as increasing your returns, lowering your risk and increasing your returns. Anything that positions itself that way needs to be questioned. Lower risk, higher return. Effectively, what these products do, I think, is they may slightly lower your risk, but you're reducing your return as well.
Well, the other thing is these things are sold into the market. So basically it's a bet that's being placed and the market's going to price the likelihood, right? So to a certain extent, the price that the revenue you're going to receive is proportional to the likelihood of an outcome. So to the extent that a market is efficient, you're really not going to get, there's no advantage there for you. The market, if the market's being efficient at that time, less all the transaction fees, and it's not a lit market, so the fees are a little bit tough to discern sometimes. It's the deck is stacked against you, but they're relying on the investor wanting that income and thinking an income is dividend, and dividend, and all I want is a dividend. I'm going to put all my money in this investment, and I'm just going to spend the dividend because that means I'm just spending profit. And in their mind, with their grill of math, that's what makes sense. They don't necessarily understand what they're getting into.
Yeah, well, I'm glad you mentioned transaction fees as well, because that's my other issue with these products. Is they tend to be they usually have a reasonably high management fee on them. Like it's a pretty simple strategy at the end of the day. So to layer a management fee of like 0.5% or more on them, it's very advantageous for the issuer of the product. The second part is your transaction costs tend to be quite high for the ETF itself, because there's so much activity. As I said before, options expire. So you need to consistently buy or sell more and more options. And those generate commissions for not you, for the market maker or for the institution that's executing the orders. And that's a real cost to you as a holder of the ETF that is very tough to figure out unless you're scouring the ETF facts documents that Canadian organizations are required to put out. And then the third part of the transaction cost that is often overlooked is by having so much activity on these products, there's a high tax burden on a year-to-year basis. The tax cost, you lose some of the benefit of a deferral that you would typically get by investing in stocks, where a lot of your capital gain is going to be taxed when you sell the investment longer term. you're accelerating the tax hit for yourself because there's so much activity going on in these products on a year-to-year basis, and the premium that you're generating is going to be taxable for you. So there's a few issues that I think are often overlooked that are a real drag on your return, especially your after-tax, after-fee return, that people don't consider. But you get an 8% yield, so it's awesome.
Okay, Josh, I need you to take a breath, center yourself, and not overreact. Okay, like can you promise us that?
Nope.
Okay, good, excellent. Because Long Point Asset Management has introduced a pair of ETFs that provide investors with leveraged exposure to U.S. stocks that are significant players in the digital asset space. LFG Daily 2x MSTR Long ETF, and there's another name I won't bother reading out. Before fees and expenses, the funds seek to deliver 2 times the daily return of the respective U.S. listed stocks, MicroStrategy and Coinbase Global Inc. Both funds are traded in Canadian dollars and have a 1.55% management fee.
Yeah. So the management fees are ridiculous. First of all, like I've talked a lot over the last year about strategies that I could execute in my basement. This is one of them, right? It's so simple. If other financial organizations cared about trying to execute this type of strategy, you could probably do it for 10 basis points and be pretty well covered, be profitable. So MicroStrategy, that's one of the stocks that they've levered. MicroStrategy, all it is it owns Bitcoin. That's all it is. The company.
But it's a strategy, Josh. It's already the name. It's a strategy, right?
Yeah. It's a small strategy though. It's a MicroStrategy. Yeah. So the company used to have some like technology platform, and basically a few years ago they said, we'd rather just own Bitcoin. We're just going to own Bitcoin. We're just going to sort of abandon our technology platform strategy. We're just going to own Bitcoin instead. And this has happened with a few companies recently where they just own Bitcoin or some type of cryptocurrency. They do almost literally nothing else. And the stock market, for some unknown reason, is putting a premium on the price of their shares. So last I checked, and I could be a little bit off on this, but MicroStrategy was trading at about twice the value of the Bitcoin that it owned. And again, that's for the most part, its only asset. So these stocks, if you just bought the stock, it's like a leveraged play on Bitcoin. It's like you're buying leveraged Bitcoin, essentially, is what it is. So if you're levering up that, you got leverage on leverage. And we all know how well that works out.
Oh, it works great right until it doesn't. Which, who knows when that day is going to be. Yeah, no, it's just funny because we've, kind of been following the MicroStrategy, story, or PM call on Thursdays, just marveling at it, really, just sitting back going, like, how is this a thing? And it's now turned into a double levered ETF for the 1.55% management fee. That probably is the one that I would end with, but I do have one more on my list that's not as extreme.
Yeah, but just quickly on that, by my guerrilla math, if Bitcoin falls about 25% and the stock behaves as it has historically, you've wiped out that investment, right? Because the lever that's implied with the MicroStrategy's balance sheet plus the leverage on the ETF, it could go to zero pretty quickly. So I don't know. That doesn't seem like a stretch. 25% downturn for Bitcoin could happen next month. You don't know.
But they'd also have to mark to market there. Like the market would have to accept that it was, diminished by that amount too, right? So
there's a lot of things that would need to happen, but in terms of, I think at the start of the year I said one of these products is going to blow up this year. That would be my guess. If I had to guess today which one it's going to be, that has my money.
Well, I've been skipping over all the ones that are being closed right now. Maybe we can do another podcast on the strategies that have been closed this year, because that would be a different list.
Well, the good thing with strategies like this, they're like a dime a dozen. So as an ETF provider, all you have to do is throw 30 strategies at the wall. A couple of them will stick. The rest of them you close, and a couple of them that are successful will pay for the rest. So it's a really great business model.
Well, welcome to Business Planning with Josh Sheluk. You too can be a millionaire. This last one is a little bit harder to I don't know, a bit more obscure. Because the target date funds are making a comeback, Josh. I'm not sure if you're aware of that. Target date funds have come and gone a couple of times over the last number of years, for varying reasons.
Mm-hmm.
But it's based on the premise that everything goes in a straight line and portfolio allocations should behave in a straight line. And, in order to keep you from making mistakes, we're just going to buy this product that's going to reallocate the money from equities to fixed income over time based on a straight line. That's the premise. So the CIBC has launched education portfolios. So you can now have a target date fund for when your kid goes to school. All right. So let's start with, is your kid really going to go to school? As a parent, that's not for sure. Like, so let's start there. Like, if you're buying a target dated fund for, the 2045 education portfolio, a lot's got to happen for your kid to go to school in 2045. So that's probably not in a straight line. But yeah, so they've launched a whole list of education portfolios in 5-year increments. And the idea is that they control the movement between equities and fixed income over that time. Target date portfolios have an annual management fee of 1.65% and an annual fixed administration fee of 0.1%. So you're at 1.75%. The portfolios are actively monitored. That's interesting. They chose the word monitored instead of managed. Actively monitored by a CAM investment team. So the weakness of the target dated funds has been manifold, but as it gets closer, because the theory is that you're largely fixed income by the target date. And if you get to the point of being largely fixed income and you're still charging 1.75% as a management fee, that's extreme. Would that be an unfair characterization, Josh?
No, I think that point is well made. I don't hate these products because I think for a lot of people, they could do a lot worse. And I guess when we're talking about worst product launches of the year, I'd say this ranks way, way, way down that list for me.
We should have ended on the last one, I know, but this was on my list. I want to
Yeah,
discuss the
but
limitations of it.
yeah, I think the point that you're making is like you can't really you should be reevaluating what your priorities and your timelines are on a regular basis, and you shouldn't let a product that you own reevaluate that timeline for you, essentially, is what's happening here. So now, if you never want to talk to anybody about your money and you're going to retire in 2050 and you buy a 2050 target date fund, you can probably do a lot worse. And the costs, it sounds like the cost of the actual product itself are quite low. So you could probably do a lot worse than this. But what we saw the last time around we had one of these cycles is they had a prescriptive bond allocation by the end of it, as you're suggesting, and they ended up with bonds when the yields were like 1%. And you're like, well, this doesn't really make any sense because bonds are maybe the most overvalued that they've ever been, and you're getting like literally a negative real return on it after time. So maybe I don't want that. So there can be some issues with them, but I think they're better than alternatives for, like, if somebody came out of this podcast and said, if I had to buy which one of the products that you guys talked about, these would be the ones that we would steer them to out of everything that we talked about today.
Yeah, no, the other, you're right, Josh. I mean, people try to set it and forget it, and there are worse ways to do it, but that's not the best way to do it. The other thing that I found with these products is that, when they talk about the equity and income allocation, they're the most basic and simple of allocations to internal product. All right. So you're talking about a government bond portfolio and broad-based index exposure, and not necessarily the cheapest of either. And like you said, you highlighted one of the points and one of the values in maintaining eyeballs on these. When you see bond interest rates go down to 1%, and you're paying 1.75, it's a negative real return. And that's meaningful. I mean, that's worth paying attention to and allocating differently. So I think that the idea that you can buy it, again, and part of it's the gall of, like, here's a 2040 target fund. Really? Like, we're going to sit here today and have a goal that's going to go in a straight line between now and 2040? Oh, come on. Like, just stop, please. There's value in paying attention to these. Hey, listen, you can listen to Barenaked Money every couple of weeks and, follow what we say. You'll be way better off than using target date. Right, Josh? Tongue firmly in cheek.
how do we turn this into an optimistic, something to leave people on an optimistic way?
They can be optimistic that they now know a few of the buzzwords they need to watch for and stay away from. So we have just educated people on some buzzwords that they should be careful of. So let's review the buzzwords that people should stay away from, because this is positive. This is keeping people safe, right, Josh? So if you see the word leverage, that should be a warning sign that you want to walk away from it. A single stock, anything, like any product that's a single stock, you should walk away from that. Yeah. Covered call. I don't know if we should say all covered call strategies you should walk away from. Be cautious of anybody says a covered call strategy, be skeptical for sure. Are there any other big words that people should steer away from, Josh?
Well, I keep going back to that product, enhanced high yield, right?
Yeah.
Enhanced. If I need to call something enhanced, what are you enhancing about it? I have some questions. And high yield, I can't say you stay away from high yield, because there are high yield bonds that can be a very effective part of a portfolio. But I think anything that really draws your attention to the income that you're generating specifically, you should be a little bit cautious of, because you're probably either you're not entirely understanding where that income's coming from, or you're giving up something to get that income. And unless you understand what you're giving up and understand it well, you should probably be cautious.
Yeah, those products are feeding on people's desire to just invest their money and spend the profit, is how they think of it. And when you really look at these products, oftentimes it's not that. So anything that's overemphasizing what it's going to pay out, whether they call it a yield, a dividend, or whatever they call it, they're emphasizing that piece as being better than anything else that's available. Yeah, run away. So I guess in a positive way, we've allowed people to protect themselves from, or at least added skepticism when they hear some keywords. And the good news is that basic investing still works. You don't need all these fancy products. You don't need to overcomplicate things. There is no, back me up, Josh, there's no brand new investment idea, or there's no secret investment idea that anybody needs to care about.
True. That's very true. And I think the concepts, the basic ideas that you're talking about, they haven't really fundamentally changed in decades from an investment perspective. And to add to the optimism, since we're on that topic right now, product prices in general, like the cost of ETFs and mutual funds and getting into good quality strategies, has come down, is it fair to say, exponentially over the past couple decades. And there's lots of good quality people that are giving good quality advice to get people into the right types of investments. These things that we talked about are still mostly at the fringes, which is a good thing.
Yeah, and just as an anecdote, I was watching a podcast from another institution here recently where they were interviewing somebody who was really pumping the student housing, there's been some product launch now around the student housing thing. And they spent like 45 minutes discussing the nuances of student housing, why it was a good investment. I'm going, you're spending a lot of time trying to build a story around something that basically you're building housing. Like it's not different. Like we didn't discover this week that students need housing. Like this isn't anything new. This is something we've been dealing with for decades, right? So if you're hearing that much of a detailed story about that much of a niche thing and trying to call it a special kind of investment, you're probably barking up the wrong tree. All right, Josh, was that optimistic enough? Like, did we leave?
I think so.
Empowered. We've empowered people. So go out there and be powerful. And if you like the podcast, share it with your friends and family. If you have any feedback for us, we'd love to hear it. And we're always looking for ideas for new podcasts. So if you want to send those in to us, we will do our best to be entertaining. And I don't know, Josh, I think the sweater's going to stick. I think you're going to have to make that part of one of your props for doing podcasts from now on.
It'd be my new podcast sweater. You got it.
There we go.
If your current financial advisor cannot explain how they and their firm are compensated, that's a problem. They really should be able to answer that question before you accept their advice. And if their answers leave you with more questions than confidence, it might be time to seek advice that aligns with your best interests. Contact us. No strings attached. You can find us at annoyingthecompetition.com. For more information on the subject of today's podcast or any other financial topic, please visit us online at verecan.com. That's verecan.com.
There's plenty of information there, or you can reach out to someone on the team. Thanks for listening.
Please note, the information provided in this podcast is for general information purposes only. It is not intended as financial, investment, legal, tax, accounting, or other professional advice. Our discussions are not a solicitation to buy or sell any securities or to make any specific investments. Any decisions, based on information contained in this podcast, are the sole responsibility of the listener. We strongly advise consulting with a professional financial advisor before making any financial decisions. Listeners should be aware that investing involves risks and that past performance is not indicative of future results. Barenaked Money is produced by Barenaked Capital Management Inc., a licensed portfolio management company in Canada. We operate under the regulatory framework established by the provincial securities commissions in the provinces within which we operate. The views expressed in the podcast are our own and do not necessarily reflect the official policy or position of any regulatory authority. Remember, at Barenaked Capital Management Inc., we focus on aligning our goals with yours, prioritizing integrity and transparency. For more information about us and our services, please visit our website. Thank you for listening, and let's continue to challenge the norms of the financial services industry together.